Hello, Tim Kerin here on the couch. It's a beautiful day here at Mortgage Choice in Kingsley, so I thought I'd take it outside to the bush. What I want to talk about today is the difference between buying an established property and doing a construction. The difference between moving into a house that somebody else built in the past and taking it as it is versus building the house you want and moving into it 6 to 12 months later once it's built. Most of the details of this should be an individual discussion between you and I, because it can get complicated to figure out what the right move is. But broadly speaking, there are only a few key differences between buying established and construction. So the first is stamp duty. If you buy, for example, a $500,000 established property, you're going to get charged stamp duty on that $500,000 asset which is being transferred. If instead you still buy $500,000 of value with a $250,000 block and a $250,000 build, that's still $500,000, but it's only a $250,000 block that's being transferred from somebody else to you, and so it's only the $250,000 that you get charged stamp duty on. So your stamp duty is going to be very broadly something like half in the case of a construction compared to what it would be in the case of purchasing an established property. And that can have an impact on how much deposit you need. So that's one thing to consider and one thing to look at in detail in the specific situation you're looking at. The next thing to understand is how a construction loan works once you actually get into it. With an established property purchase, you simply get the loan, and as 6 to 8 weeks after you sign the contract to buy it, you now have the loan, the full loan, and you're starting to make repayments on that full loan, principal and interest usually. In the case of a construction loan, or in the case of buying a block and building, at settlement, you only take ownership of the land, which let's say is half the total amount that you're going to borrow, roughly. And so at that point, you're only required to pay the interest on that amount that's been drawn in the loan, which is about half of the total. And then construction loans work in progress payments. So when your builder has, for example, poured the slab, they will invoice you for a progress payment on that amount, which might be something like 15%, for argument's sake, of the total build amount, or 20% or something like that. Your construction loan will then be drawn by that next chunk of money that the builder needs to pay the builder. Your loan balance goes up, and as a result, your next monthly interest charge goes up. Most constructions work through, say, 4 to 6 progress payments from pouring the slab through to completion, and so your loan will step up from that starting land value amount to the full amount during the course of construction. The other thing that goes along with that is you can't live in the house until it's fully built. So while it's being constructed, while you're paying that interest-only amount during construction that's gradually creeping up to the full amount at the end, you're also perhaps having to pay rent somewhere else, or whatever the cost of living is where you are going to continue to live during the construction. So there's a potential 6 to 12 month period there where you need to be able to fund the increased costs of, say, renting somewhere and making interest payments on a loan. But once the house is fully complete, then the loan converts typically to a principal and interest loan. You don't need to pay rent anymore because now you can move into a house. And that's the scenario a lender looks at when they assess your ability to borrow the money, that end game situation that's then going to continue for the rest of the loan term. And so from a borrowing capacity perspective, it's about the same whether it's a construction loan. In fact, it's exactly the same depending on whether it's a construction loan or the purchase of an established property. So you don't need to worry about that. The main thing is simply to look at the stamp duty and then the time frame and how your cash flow is going to work during that time frame to the end of construction. But we should talk about that in detail if you're considering a construction loan, if you're considering building the house that you want to live in, and look at what it's going to mean for you. So that's part of the service I provide as a mortgage broker, is to help you through figuring all of that out. The other thing is, as we go through the construction process, there's a lot of administration to go back and forth between the lender and the builder and you, and we help you with all of that all the way through so that it's nice and straightforward and you know what to expect. That's all for now. If you want to talk more about building a house and borrowing money to do it, give me a call and I'm happy to help. Thanks very much.